Hey there. Welcome to Introduction to the Commodity Markets. In today's webinar, we're going to talk about not only the structure and mechanisms of commodity markets, but also their function or purpose. Now, aside from our academic interest in commodities, which I know we all have, why are we here? Well, we're here because of a shared love of coffee, right? That's why we have that little heart there, because we love coffee. Now, whether we're a producer or a roaster or maybe we're a trader trading futures and options and speculating in the markets, or maybe you're a physical trader making sure coffee gets from point A to point B. Regardless of who we are in the coffee industry, we're all contributing to and participating in this idea of price discovery. So in learning about commodity markets, we're going to better understand and hopefully be able to predict the price of coffee and understand this path of price discovery. So that's why we're here, but why am I here? Why am I talking to you about coffee? Well, my name is Ryan Delaney. Nice to meet you. And first and foremost, I'm a coffee guy. Now, those of you in the industry, you know what it means to be a coffee person. For me, my background took me from a path as a physical trader. I traded certified and specialty coffees, starting in India and then in Uganda later. So I was traded physical for several years before my intellectual curiosity got the best of me, and I was attracted to the volatility and the excitement of the futures markets. So I worked for our company's hedge fund. I was a coffee and cocoa analyst trader. I did that for many years, and I enjoyed it. I loved it. But then I got tired of being in my ivory tower and trading futures and options on a screen, and I wanted to interact with the community again. And so that's when I moved to the sell side, and I began advising clients on managing risk in the coffee markets. So roasters, producers, and traders, I was advising them on which products they should use and how to develop strategies for navigating the coffee futures market. So that's me, but we're here to talk about commodity markets. And we're going to start with the function of commodity markets. So what's the function of commodity markets? Well, it's very simple. The function of commodity markets is to crowdsource the valuation and distribution of raw materials. Now, I wrote that, so you won't find that in a textbook, but you can quote me on it. See, it's in quotes. Now, it sounds like a mouthful, but it's really not that complex. All I'm saying is that the function of commodity markets is to crowdsource the valuation and distribution of raw materials. Okay? So the function of commodity markets is to crowdsource the valuation and distribution of raw materials. So let's talk about crowdsourcing. This gentleman here is a guy by the name of Sir Francis Galton, and he was a statistician. Now, Sir Francis, or Frankie, as his friends called him, went to a fair one day in 1906 in Plymouth, England. Now, county fairs back then, as they are now, were intimately connected to agriculture, farming communities, and livestock, things like that. And so they had this game at this county fair called Guess the Weight of the Oxen. And the way you play this game is you write down your guess of how much this oxen weighs on a piece of paper. You put it in the jar. And then at the end of the fair, the organizers go and they check all the guesses. And whoever got closest to the weight of the actual oxen, they win some kind of a prize. Now, Frankie here, being a statistician, he wasn't interested in playing the game. He was interested in analyzing that game. So what he did was he looked at all the numbers, and this is what he found. The median guess was 1,207 pounds. The average guess was 1,198 pounds. And the actual weight of the oxen was 1,197 pounds. Right? As my kids say, mind equals blown. Now, this is remarkable. The average guess was just 1 pound away from the actual weight of this oxen. This is better than we would expect even experts to do when they're making their guesses. Frankie called this the wisdom of the crowd, and this is actually a repeatable phenomenon. People have been studying it for years, ever since Frankie first wrote about it. And this is sort of the ancestor to crowdsourcing. So when we're crowdsourcing, we're trying to harness this wisdom of the crowd to come up with some kind of expert answer. So with a market, what we're doing is we're crowdsourcing value. We're crowdsourcing estimations of value, just like they were crowdsourcing the weight of that ox. And in the market, we call this price. So that's the crowdsourcing aspect. But let's talk about commodities. So what is a commodity? Well, first of all, a commodity has value, right? So like coffee has value, right? So we agree on that. And second of all, it's a raw, homogeneous material. Now, when I say raw, I mean it's required for production, but it's not a finished good, right? Um, raw meaning it's demanded by businesses rather than by consumers, because consumers want finished goods. We want stuff that's ready for us. And the businesses want those raw materials to create those finished goods. And then homogeneous, and this is a little bit more difficult, but when we say homogeneous, what we mean is there's some characteristic about it which is uniform. Doesn't mean they're exactly the same, but there's some characteristic which is uniform. So coffee beans, for example, they're all coffee beans. They're all the beans, they're at least homogeneous in the sense that they all come from this plant called coffee, species coffee arabica, right? Now, their homogeneity also means they're able to be purchased in bulk. So in coffee, for example, we buy coffee in bags. We buy bags and bags of beans, right? We're not looking at individual beans and saying, I want that bean and not that bean. We're buying it in bulk. Now, how do we value commodities? Well, this is a little bit counterintuitive maybe, but we actually value things differently depending on who we are. So, for example, producers value high prices. So in a bull market, producers are happy, right? Because they're selling that commodity. And consumers, they desire low prices. So in a bear market, prices are going down, then they're happy. Now, when we're crowdsourcing our valuation of a commodity, we need to balance the needs of both of these parties and really everybody in the supply chain. So the farmer needs to make their profit. Because what happens if the farmer doesn't make a profit? Well, they stop producing that commodity. So there will be less supply. And the retailer needs to make a profit too. They can't run a business that loses money, at least not for very long. They'll have to close their shop. And what happens then? Then there will be less demand for that commodity. So this is kind of Econ 101 here. It's just sort of the basics of the supply and demand curve. So it makes sense, right, intuitively. When prices go up, supply increases. When prices go up, demand decreases because it's too expensive. And the opposite's also true. Price down, more demand, right? You want to buy lots more of the product because it's cheaper. It's easier to buy it. But the producers produce less of it when prices are cheap. Now, we're going to get a little bit more difficult here. And let's talk about something maybe a little bit more controversial. So is green coffee a commodity? Well, it's raw, right? At least in the sense that it's not roasted. So it's definitely true that green coffee is raw. It's a raw material. It has value. I think we'd all agree on that. That's why we're in this business. We think coffee has value. But is it homogeneous? As a former specialty coffee guy, this kind of hurts my soul a little bit to say coffee's homogeneous, right? I mean, it comes from so many different origins all over the world, each with their own characteristics. You've got different species of coffee, different varieties of coffee or varietals. We grade it by bean size. We have different preparations, all different ways that we are categorizing and differentiating that coffee. So we certainly can't say coffee is homogeneous, at least in the same way that we can say gold is homogeneous, right? Because gold is an element. You literally can't even break it down any further on the periodic table. But consider this. This piece of artwork here is gold. But this comes from the Museo del Oro in Bogota. And the gold, arguably, is the least valuable thing about this piece of work. What's valuable here is the craftsmanship. It's the history, it's the story that goes into this piece here. So we can say that it is gold, it's made from this commodity, but its true value, the real value in it, is the differentiation from that commodity. We could melt this down, and then the value of it would simply be its weight in gold. But the other characteristics that we discussed, it's all of those other things about the history and the artwork and the craftsmanship, that is the value, that it's differentiation, what makes this particular thing unique from the commodity. So in the same way as this piece here, the individual coffees that we know and love and trade, those take their value by their differentiation from the commodity. So although they are the commodity, although those different coffees are a commodity, the particular types of coffees have value beyond it. Okay. Now, we talked a little bit about relative value and how the different people in the supply chain value the commodity differently. And this actually facilitates trade. It moves the objects around the world. So I'll show you in an example here. Let's say Steve Jobs has a ton of iPhones, and he wants money to invest in his company, right? He wants to hire new engineers and programmers, and he wants to build an iPad or something. And I have money, not very much, mind you, but I have some money, and I have no iPhone, so I'm sad. Look at my face there, I'm sad. So I give Steve Jobs $600, and he gives me the iPhone. And then we're both better off. See, I'm happy now. I got my iPhone, Steve Jobs has his money, and we're both able to do what we want with our respective things. Steve's able to use that to invest in his company. I'm able to text and call my friends and take pictures of my kids, right? But our difference in valuation of that same object and the money enabled that good to change hands and to physically move around the world. So in this way, we're moving goods around the world through this difference in valuation. So we talked about the function of commodity markets, right? How the crowdsourcing, the valuation and distribution of raw materials, right? That's their function. That's all very theoretical, though. Let's talk about how it actually works. So the trade distribution system with commodities has two main parts. We have the physical market, where we're actually moving physical goods from point A to point B. And then we have the futures market. And the futures market is less concerned with moving things from one place to another, although that's a small part of it. But it's more about changing ownership. So from Jack to Jill. So talking about the physical commodities, the physical commodity distribution system, this happens with something called forward contracts. Now, forward contracts are just a piece of paper that specify the responsibilities of the buyer and the responsibilities of the seller. So the quantity, the quality, the price, location, and the time. And the time is particularly important in trading. Not only because transportation takes a long time with commodities, we talked about bulk, right? These are big things. They have to be put on the ships, and then those ships have to sail around the world. So transportation takes a long time, and that's one reason why it's an important factor in a forward contract. But the other reason is that the production of commodities and the consumption of commodities move on different time frames. They don't match up. So the producer, especially in agricultural commodities, produces according to a schedule, according to a harvest, right? And that's dependent on the biology of the plant. So in coffee, for example, you get the bulk of your production in the northern hemisphere in December, right? October through February, whatever. So that's when they're producing their harvest. And the consumer, especially of coffee, but most goods, they're consuming at a relatively stable rate over time. There's some seasonality, but not much. It's relatively stable. You don't stop drinking coffee at one time of the year. So to mediate between these two different time frames arose the trade. And the trade buys, or rather they smooth out that curve from the farmer into the curve of the consumer, the producer and the consumer. They smooth out that curve. And they do this through forward contracts. So the trade will buy from the farmer. Remember, time is a factor in their contract, so they can buy before the harvest. They can say, hey, you'll deliver to me in 2 months. Or they can buy during the harvest, and they can say, I'll buy it right now. Or they can buy it after the harvest. The farmer still has some of their crop left over in their warehouses. They can sell it to them then. So time can be whatever they want, and so the trader and the farmer can pick their time and their price and their quality. And they do the same thing with the consumer. They can sell the consumer their entire year's worth of coffee all at once, or they can sell it to them a month at a time, but they can match up those two. And the way that the trade does this is by acquiring an inventory of that commodity. So they buy up a bunch of coffees over time, they stick it in their silo, and then they can give it to the consumer when they need it, because they've got that supply, that inventory. Now, the trade started trading with each other because sometimes they might have too much of one good. Maybe they don't have enough local consumers. So one trade house will trade their extra supply to another trade house that has a need of it, that has more consumers in that part of the world. And vice versa. Maybe someone else doesn't have what they need, so they call up another trade house and they buy a contract from them. Or maybe it's a specific quality that they're looking for. And so they develop this secondary trade in forward contracts over time. And what happened is that this secondary trade in forward contracts evolved into the futures market. And so the futures market is just, or the futures contract is just a standardized forward contract. So it has standard terms, like in Arabica, for example, we have a contract size of 37,500 pounds. They have standardized delivery, both time and location. So locations like there's exchange-approved warehouses and ports in the U.S. and Europe. And then times is, again, a very important factor in the futures market. So each futures contract has an expiry. It has a time when that contract must be delivered upon. It has a cover month. Now, the fact that these are standardized creates liquidity because it's much easier to trade something that stays the same. So these futures contracts, because the terms are all identical, are very easy to trade back and forth. Right? You don't have to think too much about it. It's not difficult to value it because it's all the same thing. The important thing, though, the reason why these are useful, though, is because they have a correlation with the physical commodity price. And this is only possible through certified inventory. Now, certified inventory, or certified stocks, as we lovingly refer to it, is just units of the physical commodity, lots, if you will, or stock or something, or units of bags. So it's a unit of the physical commodity that's passed an inspection by the exchange. Okay, so that's how they maintain that uniform standard. It's passed an inspection. Then it's stored in exchange-approved warehouses, and it can then be exchanged for a futures contract, either selling or buying. Now, this fact that it can be changed for the futures contract is what ensures that the physical price equals the futures price, right? Because they are constantly being exchanged for each other. And this happens during a process called tender and delivery. So remember we talked about how each futures contract has an expiry. Well, every future must be closed before it expires, right? Remember, a futures contract is just a standardized forward contract, and the forward contract has a delivery as part of the terms. That's the whole point of a forward contract. So before that contract expires, you either have to trade out of it, which means you sell your longs and you buy your shorts back, or you go into notice period. And in notice period, that's when that turns into an actual contract where you have to deliver the physical. So buyers must accept certified coffee for delivery, and sellers of futures must actually tender certified coffee for delivery. And this ensures that the price of the futures equals the price of the physical. So that's how that works. That's how the futures market works in terms of the mechanisms of it. But who uses it? Well, we picture futures traders as something like this here, the pit, as it used to be called. But for better or for worse, that's mostly gone now. And most of it's done electronically. But just like with a forward contract, the major player in the futures market is the commercials, so trade houses. And they're trading both sides. They're trading long futures on behalf of the roasters, and they're trading short futures on behalf of the producers. But again, there has to be a buyer for every seller. So the other person that the trade house is trading with is the speculator. And so when the trade house is bearish, the speculator is bullish, and vice versa. Then there's also the financial institutions. And the financial institutions are trading on behalf of groups like index funds, right? Where they want to have a representative position in a whole bunch of different commodities. Maybe they've got an agricultural index fund that has some of each different agricultural product, or they've got a commodity index fund that's got some of agricultural products, some of energy, some of minerals and metals, etc. And then, of course, the financial institutions, being financial institutions, Well, they're trading with everybody. So they have positions on with the specs. They've got positions with the roasters. They make financial products for them. They make financial products for the producers. And then they trade with the trade houses as well. Now, the net effect of having all these different people and players in the market is liquidity. So that means that the producer will always have someone that they can sell their coffee to, their commodity to. And the consumer will always have someone that they can buy from. So if it was just the producer and just the consumer trading, then they could only trade when one or the other wanted to. And if, remember we talked about the difference between consumers and producers, that means that if the price was low, only one side would want to trade, and if the price was high, only another side would trade. But the fact that we have all these other different groups in here means that there's always someone that will trade with them. So that's how the global futures market works in a nutshell, right? It's a market for standardized forward contracts. So that's all the futures are, is they're a standardized forward contract market. The prices, though, of the futures market are kept real, meaning that they correlate with the physical through certified inventory, and that process of tender and delivery we discussed. The net effect of all of this is that we're getting an aggregate valuation for that commodity. All those different players we just discussed, they're all making their trades based on their own estimations of value of that physical commodity. And that's why the price here represents this aggregate valuation for that commodity. Now the irony here, this is my ironic sign here, I'll give you a second. The irony here is that the commodity market actually helps us to de-commodify coffee. When we hedge with futures, we're offsetting the commodity risk. So we might have a physical and we sell a future against it, and that actually allows the value of that particular coffee, that particular quality, to shine through. This also provides a financial incentive to the farmer to produce better quality coffee and to differentiate it with different types. This insulates them from the commodity market, and it provides a better quality of coffee and more variety to the consumer. So thank you all for your attention. This has been Introduction to the Commodity Markets. I was going to say I hope you all enjoyed this, but who am I kidding? I'm a great teacher. I know you all enjoyed it. You had a good time. I had a good time. And you learned something, hopefully something useful. But don't get cocky. We only just scratched the surface today. Today's webinar was just an abbreviated version of one lecture from one day of my 5-day Coffee Traders course. This course covers the 5 core subjects you need to know on your journey to coffee trading mastery: commodity markets, fundamental analysis, technical analysis, derivatives, and price risk planning. If you'd like to continue your journey, then come to coffeetradingacademy.com and register for the full course. This course starts in a little over a week, so if you're interested in joining us, I'd encourage you to register online or drop me an email. Everyone who participated on this webinar today will get a discount off of the full course. Now, the other thing I offer at the Academy is information and reports on the coffee market. My aim is to democratize access to information in the coffee industry, and that's why I offer free and affordable premium subscriptions. So if you need to know the coffee market for your business, then I'd encourage you to subscribe on our website. For the next couple of weeks, I'm going to be offering free trials of all of our premium subscriptions, so you have no excuse not to know what's going on in the coffee market. Now, and I guess I should introduce my mascot here. He's a coffee ninja. His name is Joe. Say hi, Joe. So thank you again for joining me today. Don't forget to register on the website or subscribe if you want to get more information. Feel free to reach out to me if you have any questions. I look forward to seeing a select few of you on the next stage of your journey at the Coffee Traders course.